everyone. Welcome to the Viking webinar. I'm your host, Vikram Raya, and I have a couple of friends here who are going to co-host it with me. Chris Parinello is my Vice President of Investor Relations. I have my good friend, Judah Fold, who is my Vice President of Acquisitions. Welcome, guys.
Hey,
Hey,
Vic. Hey, Chris.
hey, Judah.
All right, so today we have our Viking webinar. We have a lot of new folks. We have a lot of existing folks coming to join us. What's your take on the markets right now? What's your take on some of this volatility, Judah and Chris? Let's kick the ball off here.
Yeah, no problem. I mean, listen, I was in Atlanta this past week, Nashville a couple of weeks ago, obviously, and I was at a conference a week and a half ago that had about 700 other owners there as well. The sentiment really was the market's still slow, rates are still tricky, which is kind of why we'll talk in a bit. Having a loan assumption here with a good rate is so advantageous. It's hard to underwrite what's going to happen post going under contract until you get to close and lock in your rate. So anytime you can get increased stability, there seems to be a lot of interest in some of those deals.
I think I've been, saying this for the last few webinars. Interest rates staying high just continues to keep our buying window open, and we just get a better and better basis every deal that we do. So I think it's great, and things are going to be moving in the right direction soon, which will help some of the deals in our portfolio. But right now, we just really need to take advantage of the deals that are out there.
Yeah, I totally agree, guys. And for those of you who are just joining in, we're going to do a presentation on our latest deal, Hamilton. I'm excited to present you Viking's 31st project. For those of you who are new to Viking, I'd like to welcome you guys to the family here a little bit. This is going to be a really powerful, opportunity for you guys to learn about who we are as a company and about the investment opportunity. And for many of you, this is your first time with us, so I want to introduce myself. My name is Vikram Raya. I'm the CEO of Viking Capital. And tonight we're really going to talk about not just a project or a real estate investment, but we're going to talk about long-term wealth building, right? We're going to talk about the principles of the greatest investors, in the world and what they did. They figured out how to find opportunities. They figured out the arbitrage. They figured out how to build passive income, and they invested alongside strong teams and proven teams. And hopefully we can prove to you that we're one of those kind of teams. And I think you're going to really enjoy this project that we're going to present to you. I think it's a compelling opportunity in one of the strongest submarkets we found in a while. And we've been trying to break into the Nashville, Tennessee market for years. And finally, we found the right project to present to our investors. So I think you'll enjoy that. Before I get started, let's do something very quick. If maybe you can put in the chat box where you're from in the country. That'd be great. And I want to make sure audio is working and all that. So if you can hear me, please put in the chat box where you're from. And yes, that video was supposed to have a little bit of audio sound, but you guys got to go with the flow. So trust me, we're going to have some hi-fi production on our next webinar. We'll be fine. Great. We got Michigan, Phoenix, Boston, Orlando. We got New Jersey, DC. We got Richmond, Nashville, California. We got the whole country, Chris, Judah. Looks good. Okay.
Yeah, it's great. We have investors from all over the country, getting to talk to them, diverse perspectives. One thing in common is they all seem to like passively investing in real estate, and happy we can help them do so.
Absolutely. And the other question I want to ask is, hey, look, if you're a first-time real estate investor, love to see your put some yes or something in the chat box. Or if you've already been making some moves in real estate, love to know that as well. Experienced or first time, love to see that. If you're first time, put new to the game. Or if you're experienced, hey, look, I've done multiple investments. Great. Okay, we got some new folks who are interested in learning more about real estate. That's fantastic. Okay. And so we'll get started here. And so you can go to the next slide. So, Viking Capital, we started Viking, guys, in 2015. And a little bit about my story. I'm a cardiologist. I was a full-time, professional like many of you. And, I enjoyed what I was doing. And for many years, I practiced. But as I started learning about the value of time and of leveraging, my money to work for me and to create passive income, I really sort of fell in love with real estate investing. And with the person you saw on the previous slide, which was one of my partners, Ravi Gupta, we ended up launching Viking Capital just to find opportunities for high income individuals like ourselves. And pretty soon we realized, hey, this is something we can really take to the next level. And we progressed from what they call a syndication company to now what we're really is a full-fledged private equity investment firm. We have that institutional rigor and the capabilities of an institution, but we still care about the individuals that are in our investment sort of nest. And we give you that white glove, high touch service to people who are like us, who are like, successful professionals or entrepreneurs, dentists, doctors, lawyers, accountants, startup founders. And then now we even have a couple of family offices and some high, ultra high net worth individuals who join us. So we've really created this opportunity to have, this group of individuals, and we find these opportunities across the country. And at this point, we've crossed a very momentous occasion. We've done about $1 billion of transactions since we've started in our inception in 2015. And we choose to find high growth areas, landlord friendly states, and we look for the opportunities, they call asymmetric risk reward. So, congrats to the full Viking team. Congrats to all our investors who've supported us along the way. And let's go to the next slide. So keep going. My background, as I mentioned, I'm a cardiologist, but I've been in real estate since 2012. I've started in single family homes, and then eventually I realized that multifamily is an asset class that's where the smart money isn't being invested in. And we started in our home base of Atlanta, and now we have a portfolio across the country. We're in about 8 or 9 states right now, maybe 15 different MSAs. Next slide. I want to introduce one of the co-hosts for this evening. It's Christopher Parinello. He is our Vice President of Investor Relations. I'll let him say a few words.
Yeah, thanks, Vic. My background, I really, spent my career working in real estate private equity, from hotel development to multifamily. Really, this is what I'm passionate about. And, the education doesn't stop here. After this presentation, you're going to have a great overview. Reach out to me and my team. My team will be putting a book a call link in the chat throughout the webinar, and we'll be happy to go through the model and all the specifics and nitty gritty of the deal later on.
Next slide. So Judah is our Vice President of Acquisitions.
Thanks, Vic. And congrats again. You're a little humble before. 10 years at Viking, building this company. Kudos to you and Robbie. It's been a great joy to be there for a bunch of the ride. Myself, I was never a doctor, but I was once a lawyer. I used to practice law starting out in criminal defense and civil litigation. Eventually, I crossed over to the real estate side, representing various types of real estate owners, retail, industrial, education, before crossing over to the buy side of real estate, some time in investment sales, capital markets, before joining Viking to lead acquisitions. Really put a lot of work into this one. This deal itself is coming on about a year in the works, given the history of it, how eventually first another buyer came in to buy it. And, we kind of came in when they fell through at a lower price. So really excited to share all this with our investors.
All right, next slide. Great. I'm going to quickly review a little bit of our track record. As I said, we've acquired over almost close to 6,300 units over our time span. And really, I went to Emory University. I went to Emory undergrad. So I really knew Atlanta very well. I grew up in Atlanta. So that was really one of our pockets. It happened to be a very top emerging market. As we moved on and expanded and took advantage of the different economic cycles that were, Texas was a big market. We got into Indiana. We've got into, Phoenix recently. We have a deal in Washington, D.C., and then now we're entering Nashville. So that's sort of our expansion and our phase of growth. Next. We've done 30 large multifamily acquisitions so far. I've talked to you about the units. We've hit about $1 billion of assets acquired, and we've been obviously in business for about 10 years. 24% average ARR to our exits that we've had. Next. I'm proud to say, and a representative of all you guys on the call, we've had investors in every single state now. I think there's like one state that we didn't have for a little while, but we were able to find an investor in that state. So it was great. So what that means is you're in good company, guys. These are highly successful individuals across the country who are looking for an investment platform that they can work with programmatically. And I think we've been able to check off most of the boxes that most people are looking for. And I think as you go through the presentation, you'll see the attention to detail, some of the due diligence we do on your behalf to really find these positive deals. Next. So the concept really is, before I talk about the multifamily project, is why multifamily? Why is that an interesting concept? Well, I have to give you a little bit of a background, especially for the people who are new to the game. There are several flavors of commercial real estate, right? When you hear commercial real estate, it's a basket of terms. In historical terms, it was really office. Office was the sort of the darling of all, commercial real estate, and that's where a lot of the institutions parked their money. With COVID and other economic factors, that really is not the case any longer. And what supplanted office as the king of commercial real estate is multifamily. And so Brookstone, KKR, these huge big firms, private equity firms and large investment firms, this is where the smart money is being invested. And as an individual, why does it matter to you? Well, there's multiple ways to take advantage of multifamily. One, it's not a luxury need, it's a need. It's a necessity, meaning everyone needs a place to live and everyone needs a roof over their head. Number two, you get profit in multiple ways. It's a hedge against inflation because every 6 months to a year, you adjust rents based on, outstanding circumstances. So you get to hedge against inflation. It appreciates over time. There's organic appreciation and forced appreciation. We'll talk about that today on the call. There's profit when you sell. There's tax benefits. You get depreciation. There's consistent housing demand. There's year-over-year rent growth. And there's cash flow. And as well, it's a portfolio diversification against some of the assets you already own. Probably you own crypto or you own equities in the stock portfolio. This is a nice complement to that as well. Next slide. So rent growth saw historic numbers probably in like 2020, 2021, especially when the government pumped in all the liquidity into the markets. And then after that, there was sort of a correction, if you will. And now what we're seeing is sort of the uptrend of that coming back online. So in 2025 and 2026, you can really see there's a steady pathway for rent growth back up to 3, 4, 5% in many cases. The reason why we like Nashville is it really didn't see that much of a dip, and it's having strong, steady rent growth about at least 5%. We're being conservative in our underwrites, and we didn't even include something as aggressive as that. But you can sort of see here how 2023 and 2024 were, or 2023 was definitely a down year. In 2024, things were starting to improve, and now we're really on the path of recovery. So I want to applaud you guys for coming in and potentially seizing an opportune time to get into things such as commercial real estate. So among the top 5 metros for effective rent growth in 2025, Nashville ranked number 2, which is amazing, and Kansas was number 1. So in Nashville, average effective rents have been like 1465. They're predicted to go to 1547, 5.6% increase year over year. So what's really driving this demand? Keep going. So it's really the affordability gap, right? And not to mention the tariffs and any of the downstream effects of all that. But even before all that happened, with the mortgages is where they are, and just everyone who already has a home has a low mortgage, no one wants to leave. So it's interesting. There's a shortage, but there's also difficulty to buy homes. And so it's creating this affordability gap. So the average home, at least in the area where we're looking at, was $419,000. And to rent, it's a lot cheaper. So there's usually a $1,500 to $2,000 rent gap between renting and buying. And what's fueling this rental demand? There's two things. Well, older people are deciding, as they downsize, they want to go back to renting. And this millennial generation is delaying when they get married. They're delaying when they eventually buy their first homes. And so what happens is the rental pool is increasing. Normally there's like these pockets of rentership, and then people eventually go to home ownership. But that time frame has extended, not only because of affordability, but now due to personal lifestyle and preferences. These are the things that really make a project very attractive to millennials. They want modern design. They want attractive amenities. They want less bedrooms, actually. If you can throw in some, environmental friendly things, they're excited about it. Obviously, they want to be close to, locations that are attractive to them. And then, instead of trying to fight the federal funds rate, we look for opportunities where, next slide, please. We look for opportunities where, you go where the people are moving, where the demographics is going, right? It's called positive net migration. So as you can see here, the federal funds rate and the 10-year treasury, this is what debt is based on. They've been very volatile. And so the two things we've done, especially on this deal, is one, we have a very low fixed rate debt that we're assuming. So we don't care what's happening in the greater economy at this point because we're protected from the interest rate volatility that's out there. And the second is we're taking advantage of where the demographics is going. Next. So when we could try to construct a deal for our investors, we try to figure out how to bulletproof it, right? And either you sit out for several years in the market, or you decide, hey, how can I take advantage of the market that is existing? And so one, we've tried to figure out ways to get low fixed rate financing. Why is this important? It's secure, it's predictable debt structure. Number two, we want stable leverage, ideally positive leverage. And you'll see here, the cap rate on this deal is about 6.2. The interest rate's about 4.8. So there is positive leverage, which is amazing. This cash flows day one without any additional renovations if we didn't have to do that. And it's the strong renter demographics, the high income on the property, high income surrounding the property. I have a statistic here. It's $125,000 average household income around the asset that we're going to show you. So that's the kind of deals that make sense where we're like, oh, wow, this is a strong, safe deal despite the market volatility, but it makes sense even with the upside. And so with that said, we have our 31st investment offering we're proud to present, and that is the Hamilton, which is a Nashville MSA 232 unit property. It was built in 1985, but mind you, it was been heavily renovated with a full renovation of the interiors in 2020, and then they've replaced all the roofs in 2024. So when you look at it, it feels like a 90s or a 2000s property. And again, there are reasons why we like this deal, and I'll let the other speakers maybe comment on it as the slides go on. But sort of some of our top reasons as a team were really, this is an affluent suburb. There's three major affluent suburbs in Nashville. There's two in the south and one in the north. Hendersonville is the one in the north, and that's where this property is located. It's affluent. It's supply constrained. I think they're only producing, I don't know, 250 units total over the next 5 years. So there's no supply coming online. So, and then the final reason in terms of location is it's an A-rated school district. And we know as parents, this is very important to where you want to move. So it's an attractive place to attract the right demographics. There's no new construction and there's a ton of organic rent growth, cash flow from day one with minimal CapEx needs. So again, if we decide to just go in and just manage it better than the previous group, we're going to start cash flow day one. And then there's a rent to own gap. So again, if the people who want to own compared to the people who want to rent, there's enough of a moat there to where it's going to be very hard for those people to become homeowners due to the down payment and due to the interest rates on these mortgages. And then finally, because of the debt, the smart, intelligent debt we're assuming, which is fixed, it allows us to really maximize our returns for our investors. And so with that, I'm going to hand it off to Judah, and he can sort of break down the deal.
Thanks, Vic, and thanks for teeing it up. So as Vic mentioned, the Hamilton is our next acquisition. We are very excited about it for a whole bunch of reasons. 232 units built in 1985, although as Vic mentioned, because of the extensive work and the high level of care that the seller has taken on the property, it shows even better than a typical 80s product. At 655 unit square foot average, it's a very efficient floor plan. It's a very efficient property, which definitely helps manage it also in an efficient manner. Let's keep going to the next slide. So one of the great things about it that stood out is the cap rate, right? We are getting this at north of a 6 cap. You may remember a couple of years ago, deals trading, below a 4 cap. We never did anything like that, but a lot of deals were in the 4s. Then we started getting excited. Deals were coming up to a 5 cap rate. This one is north of a 6 cap. And that's even with the loan assumption. So the positive leverage day one is inherent in the deal. It's been managed very well, very efficiently. This is a seller who we've bought from previously. So we've already transacted with them. We've seen how they manage, no skeletons in the closet, and efficiently at 36%, they've really managed to dial down the property to an efficient operational level. Highly occupied. This thing has been 97 or 98% occupied for at least 16 to 18 months during that time period that we've been following this property.
Yeah, and I want to stack on one thing, Judah. I know because of our relationship with the seller, again, this was sort of gone off market where it went and got listed and then didn't transact. But then because of our relationships, they came to us and said, "Hey, would you be interested in taking this down?" We stuck to our pricing, and so we were able to get close to almost $1 million discount on the deal when we acquired it as well.
Correct. Yeah, we are excited to work with them again. We had a call with them today, and it's been kind of rinse and repeat from the first go around. So we're certainly fortunate to have that relationship with them. Keep moving on. They redid the clubhouse, and I'm glad you guys got a peek there. A lot more pictures kind of coming on as well. Let's just dive into the highlights of this investment really quickly. This deck will be available if everyone wants to read it in more detail. As Vic mentioned, nearly fully renovated already. We're getting a strong cash flow just from the kind of lower purchase price. It's an institutional quality asset that's been owned by several institutions before us, and they've taken really great care of it. Business plan, very simple here. It's already cash flowing at a good cap rate. We don't have to build it to a 5 cap. It's already a 6 cap. This is a high income area. No one here wants to be using a laundry room. They already started installing washer dryers in the units. We are going to install those washer dryers in the rest of the units for the $40 to $50 premium that you get for making those installations. There's some organic rent growth that's already been going on site. Vic mentioned projected 5% rent growth in the market. We've underwritten less than that to be a little more conservative there, and it still drives higher cash flow. Continue as the seller is done to optimize expenses and just efficiently manage this property. The fact that we have revenue upside, given the low risk, is the asymmetric risk reward that Vic mentioned earlier. That is what we strive to look for. Now let's jump into the debt. Here we're taking a sub 5% loan already in place, already fixed. That means between now and when we close, there is no interest rate volatility that we are subject to. You can watch the market go up and down. It's not going to impact the numbers here at all. And even with that, sometimes you'll assume a loan and you're getting pretty low leverage because it's the original loan amount from years ago. Here, we're still getting 70% leverage on our purchase, which is right around the threshold we actually aim for. And Vic already talked plenty about the location itself. A lot of industry here. Gap has their headquarters a few miles away. This is the suburbs of Nashville. So we're, like Vic mentioned, we're a northern suburb. I've seen in the comments, people asked, what about the supply we've read about in the news in Nashville? That's all downtown. There's been a bit of an oversupply downtown. There's been an undersupply here in the northern suburbs, which is what's leading to the continued rent growth, whereas other parts of Nashville are maybe seeing a little bit differently. Let's keep going. This is our 31st acquisition, as Vic mentioned. One thing we've seen is when we rebrand the property to our Elevate branding, we bring in the similar finishes that we've put in the rest of our portfolio. Thankfully, we're getting market recognition for this quality. We further plan to kind of implement all that here as well. One thing to highlight here, which I want to mention, is the delta to in-place rents versus the average market rents in the market. There is almost a $400 difference between the rents on site here to rents elsewhere in the market. What that makes us is, believe it or not, despite the high quality of the property, is actually one of the low-cost alternatives in the market. So we have protection of almost $400 above us to being a quote affordable option, which is what's driving the very high tenancy of this property. We expect to stay that way. We expect to capture a whole bunch of that delta, but not all of it, because that's what's driving the high quality occupied rent roll with very high quality tenants.
Okay, so for those who haven't invested with Viking before, we set up all of our deals with a 3-tiered equity structure. And what that means is that you have 3 different classes. You have Class A, you have Class B, and what we call reserve. Class A is going to really prioritize cash flow. So you're going to get 10% preferred return built into the economics. So that means you have priority over the other classes in the deal. And what you're giving up to get that prioritized cash flow is you're giving up the profit share at the disposition of the asset. The minimum investment for Class A is $50,000. Class B is going to be the flip side to Class A on your common equity share. So you're still going to have a 7% preferred return. Now, the cash flow that you're actually going to get from this deal is going to be based off of the cash on cash on the average over the hold period, which we'll discuss on a later slide. But in addition to the preferred return, you're going to get the 70/30 profit share when we sell the deal, meaning that 70% of the profits are going to be going to you as the LP, and Viking gets 30% of the share that represents its promote. This also carries a minimum investment of 50,000. Reserve class is a class that enhances the returns, increasing the preferred return to 8%, and also the profit share from 70/30 to 80/20. And this is reserved for folks that are investing 500,000 or more. So here on the left, you have the capital stack, and you can see how much we've allocated for reserve investors, Class B and Class A. Obviously with Class A taking a higher prioritized cash flow, expecting a 10% return over the hold period, we've minimized it to where the deal can support paying, 10%. So that's 1.8 million. Class B is the biggest chunk of common equity for 11.45 million, and 4.5 million going to the reserve class, people that are investing 500,000 or more and getting those enhanced economics. And then at the bottom of the stack, you have the debt, 28.25 million. Further to the right, you have the purchase price, the loan amount, and the total equity, which is the capital structure broken out a little bit differently, totaling up the equity to 17.7 million. And then you can really see the Class A, B, and reserve structures more represented on a table. So you're looking at that preferred return, 10%, 7%, and 8%. The hold period of 4 years remains the same, but you start to see the differences with the equity multiple. So the 10% over 4 years represents a 1.4 equity multiple. Class B, as you take on the cash on cash, which is averaged to 5.25 over the 4-year hold period, and you add that to the back end promote, your upside goes from 1.6 to 1.8%. Go in the middle on a $100,000 investment, that would be about a $70,000 upside, including your cash distributions and your total profit share. And reserve, when you invest that larger amount, you're getting increased returns up from 1.7 to 1.9x. These are projections and they could go up or go down, but this is what we've modeled out for this 4-year hold. The average cash on cash remains the same for Class B and reserve, but you can see the average cash on cash for Class A, because you have that prioritization, you're getting 10% cash flow, and the remaining cash flow after you get 10% is what makes up the 5.25 cash flow for Class B and reserve. And then the average annual return, which is what AAR represents, is 10%. That preferred return that you're getting is your average annual return. And with Class B and reserve, it's increased as you factor in your promote split. This next slide really breaks it down. I think it's easier to kind of see exactly where the cash is coming and when you're expecting to get your distributions. So you go back to that Class A investment. If in year one, you're getting a 10,000, this is based off of a $100,000 investment, you're getting a $10,000 return, and that's going to be broken down into 12, we do monthly distributions. Year over year, you're getting that 10%. When we get to year 4 and we sell the property, you've received your return and you get the return of your principal, netting you a $40,000 return on a $100,000 investment. Class B is a little bit different. So you're getting 5% in year 1, 5% in year 2, 5.5% in years 3 and 4. Those combine to make that average cash on cash of 5.25. And then when we sell the property, our model indicates that 70% of the profits your share of that as a $100,000 investor would be a $44,000 profit. So if you add up the cash flow that you get over the 4 years, along with your equity split, your total return would be $65,000, and you get your return of the $100,000 investment you make. Now, the reserve class, you can see the cash flow is amplified because it's multiplied 5xing over a $100,000 investor, but you're also getting a more healthy equity split, taking on 80% of the profits from the deal. So your $500,000 investment creates $350,000 of total return. So sensitivity analysis, we put this in the model in this deck to really kind of show you the effect that exit cap rates have on the total IRR, equity multiple, and average annual return. In the model that we create that we will share with you, and I encourage everyone, I know everyone's been putting a lot of questions in the chat, and we'd love to be able to answer those questions in the middle of the presentation, but it's just more efficient for us to answer those as a Q&A at the end. And anything that doesn't get answered, please book a call, reach out to my team. There are a handful of us, 4 or 5 folks in the investor relations department that are standing by, waiting to answer all of your questions, go through the model with you, really help you get comfortable in the deal. But this portion of the deck is really just a glimpse into how the exit cap rate will affect your overall return. And there'll be sensitivities like this in the model when you're able to review it at a later date. This is the same sensitivity analysis, but for reserve class. So really just quickly to point out, you can see as you go down in your exit cap rate, it's going to increase the purchase price. Your cap rate is going to be based off of your net operating income.
Exit price.
Exit price. Yeah, exit or sales price at disposition. As your cap rate goes up, you're going to see a smaller sales price. And that's the correlation of a cap rate showing net operating income to purchase price. Now, what affects cap rates? I think that's something that we can discuss more broadly on a call one-on-one. But this is why everyone's really interested in looking at what the Fed's doing. And more importantly than what the Fed's doing and where interest rates are, it's transaction volume. So that's why it's so important to see how much new supply is coming into the market, how much people are actually going out and buying new properties, because as there's more competition in the market, it compresses cap rates because people are willing to pay a higher price. Next slide.
All right, thanks, Chris. So I mentioned a bit earlier, really great financing that we're going to be assuming on this property, taking over the loan from the seller, fixed rate, 30-year amortizing period, 70% leverage, which is near optimal, at $28.25 million. Most importantly, fixed, and we don't have to lock the rate in. It's already locked. We're just taking it over.
Jude, some of the folks are asking about how long is left on the debt.
There are 4 years left on the loan term. Well, a little more than 4 years. When we take over, there'll be about 4 years left.
Okay.
And if you look at most debt projections across the board, whether it's Fed projections, whether it's Treasury projections, 2-3 years from now, let alone 4 years from now, already project to be a much more favorable interest rate environment, giving us optionality. We can sell the property, we can refinance with improved cash flow. Let's keep going. We've already mentioned this a few times before. I'm not going to repeat what's on the slides here. What's important to know is that this low interest rate within a higher cap rate means that we're cash flowing early on in this project. That's a challenge to find in today's market, and we thankfully were able to find it here. It took 18 months of following this deal. It took someone else getting awarded the deal first and us hanging around, and the seller reaching out to us saying, hey, we need someone who can close this. Are you guys still interested? But we found it. So that low rate is what's driving cash flow. That's why it matters. Really quickly here, I mean, there's so much information on this slide that I always wish I could go, but I can spend an hour on why each one of these line items is very significant. I highly recommend you reach out to our team. They will walk you through it in a lot more detail. What I want to highlight here is the net operating income on the T12, the left circle, to the right circle, which is where we expect to be in year 4, probably the earliest we really contemplate selling this property. That growth between 2.5 million to near 3.2 million is about $11.5 million of value that we will be increasing on the property. Given the lower risk, that's this imbalanced higher reward to lower risk property. And this kind of nuts and bolts here kind of is what paints that path. Again, this property is fully amenitized. There's a beautiful pool, there's a fitness room, a redesigned clubhouse, there's a pet park, there's a tennis court that we're going to be repurposing into probably pickleball and other amenities that'll be a little more up to date. But it's a fully amenitized property. That's what's keeping this thing so occupied and drawing top quality tenants. Very efficient unit mix here. A lot of 1-bedrooms, about 80% of the property is 1 bedrooms, about a little, just about 20% 2 bedrooms. For this pocket of this nature, we are getting a lot of the kind of ancillary employees, some more young professional single folk filling up this property. There's some really nice cottage end units in this property as well. Even though it's a 1 bedroom, It feels like a 2 or 3 bedroom. So it's really nice unit mix, very efficient layouts. We walked every single unit aside from 4 still to be walked. And then really each unit shows very nicely. Another view of the clubhouse here, really well tastefully done by the seller and the seller's design team, leaving us some work, but a lot of the heavy lifting, already done. Again, washer dryer hookups here. They started putting in washer dryers. We're gonna get to finish that work with these high incomes. People don't want to be going to a laundry room. They want to do laundry in their apartment. The plank flooring, fireplaces, stainless steel, granite countertops. These are really high quality units. It's easy to see why it's getting top tenants. Great floor plans. Again, encourage everyone to watch the replay. Pause where you want to pause. Take a nice look at all of that. Rent comps, and this gets into what I was talking about before. We've looked at all these comps, analyzed all these comps. It's a really great set of apartments, all drawing great tenants. MAA, number 7, for example, Mid-America, they're one of the top developers and owners in the country. I think they're almost $500 above us in rent. They are way above us. Really offering an ability for us to be that affordable option, stay occupied with a lot of room to increase rents while staying affordable. Here's a visualization of that. We have a lot of room here. We have great neighbors. Some view neighbors as comps, as competition. Yeah, they're competition. When your competition is much higher than you in rent, you get to draw off their success. This is a great submarket. We're happy to see other good neighbors keeping the quality of the tenants high. Schools play a vital role in that. And this is kind of visualization of the last slide, how we see ourselves as insulated within this market. Here's the deliveries that we were talking about. If you look at the chart on the right, this answers a lot of the questions. By the way, very, very educated investors we have here today, asking some really important questions. Yes, there's been a lot of deliveries since 2010 in Nashville. Very few of those have been in Hendersonville. If you look kind of the last few bars there, that's where the deliveries have been. Tens of thousands of more deliveries. And that's where kind of there's been an oversupply. Where we are now, perfectly situated for continued rent growth, continued occupancy. The few units that have been delivered have been very well accepted and absorbed, and we stand very well positioned for continued rent growth and success as a multifamily operator. With only 247 more units, by the way, scheduled to be delivered in the next year or so. This is a great slide also. So to replace this property would cost about $76 million. That's about $330,000 per door. Our cost is so far below that it shows kind of the staying power that we have in the site and what it would cost someone to really build something else to compete with us. And just to give you an example, West End, Midtown, Music Row, that's where all these units were delivered. As you go more towards the north, this is again one of the higher income suburbs by the lake, really separated from that influx of units, well positioned, insulated by the lake and by a county that's very restrictive on building. They have great schools here. Oftentimes when a county has great schools, they want to protect their good schools. The way you protect your good schools is you actually reduce the number of deliveries coming in, because the more renters you have, the more people who can move into your district who don't have to buy a house, which they can't afford. So they've been very, very protective here, and they're very insulated from a lot of supply you may have seen in other parts of Nashville. But again, still in the path of growth. There's a lot of jobs out here. I mentioned Gap. We are kind of, last mile logistics. So a lot of the people who wanted to get into Nashville by way of delivering their supply, the last mile, they're coming out here with all their large warehouses and 1 million square foot Amazon delivery hubs. This is kind of where they're coming, and this is where those jobs are being supplied. So this is very much the path of growth. This is not the hotels that you may hear about in Nashville or Music Row. This is where the jobs, this is where the workforce housing is thriving. And then again, Hendersonville is kind of the main city in this area, top schools, great economic drivers, a lot of young professionals who want to live in a nice area. We first visited this site, I mentioned, almost a year ago to first check it out when it was first marketed. We saw a lot of retail that was being developed. We were there to do DD 2 weeks ago, and we saw all those retail developments now open for business with people, visiting them left and right. And it's top retail. It's not just retail, by the way. We pass within a mile 3 financial planning firms, right? That is opening up here because that's where the high incomes are. So the workforce, the population thriving and continue to grow. Vic mentioned the 125K average household income, 75% of the tenants in the white collar workforce, but still a healthy amount of renter occupied housing. Again, great retail nearby and great nearby amenities for tenants. Again, I encourage you to come back and look at this list. Top grocers, we sit right between a Publix and a Kroger. If I had to pick 2 grocers in the Southeast that I want to be between for workforce housing, these are the 2. The lake nearby has been a historical attraction. It's what kind of founded this community. You see almost $2 million home prices nearby. Again, very much insulating the renter market. And also it's become a destination within the greater Nashville submarket.
So let me weigh in on this slide. Guys, if you can see, the little red pin is where our team put, that's where the Hamilton is. And on the other side of this lake, this Old Hickory Lake, which is a luxury boating area where everyone wants to attend, these are the almost $2 million homes across the lake from our property. So you can see the situation of the income, the location, the demographics of what this property represents.
And it's got a nice community feel to it. When you're on site, you really get a sense of that. And while we've been saying you're insulated from downtown Nashville, you very much have easy access to downtown Nashville, right? A lot of the tenants here might work downtown. They go downtown for entertainment. They like the nicer, quieter suburb, though, for their family life and for their schools and all that. So certainly we are insulated from the rental market and protected, but easy access, which is what makes it an appealing area to live. Again, there are so many different industries going on here between you having major sports teams, major economic developments, office properties. Everyone obviously knows about kind of Music Row and the music industry. There's $5+ billion of economic impact, all just several miles from our property. And we mentioned the schools. Can't underscore this enough. Education. It drives tenants. It drives the workforce. It drives the quality of the area. And having A-rated schools, the number 2 best district in the Nashville MSA, will only kind of perpetuate the success of the area going forward. And then this last slide may seem kind of silly. Why are we showing you Knoxville? Why are we showing you like Louisville? What's the relevance here? But the reality is that a lot of the Nashville MSA being a little bit farther apart from other MSAs, unlike you'd have in the Carolinas, unlike you have elsewhere, really it's what affords the MSA itself so much strength. If you want to benefit from everything Nashville has to offer, you're living in Nashville. And if you want to live in where better schools are, you're living, at this property and in Hendersonville. So it's always good to see kind of where it lies in the greater region. And Nashville, it's what's driven its success for the last, really, call it 15 years.
Okay. Thank you, Judah, for that overview of the submarket. And thanks, Chris, for breaking down the investor stuff. So, my friends, I just want to talk about really Nashville as a city and understand the reason why this MSA speaks to us as a really attractive investment option. It's been rated as number 1 by real estate investors as a place to invest, leisurely travel, ideal working age population, best city to watch. Next slide. The growth is real, right? This is from a lot of the population data from 1910 to 2070. They're thinking that the Nashville population is going to grow 37% more than the national average. They're expecting to add 600,000 new folks to the MSA in the next 10 years. We mentioned the discrepancy in Nashville of renting versus buying. Average home price in Nashville is $535,000. The mortgage on that is $3,100. The average rent is $2,000, and that's already a $1,000 affordability gap. Remember, our rents are at $1,300. So we have a lot of room to go up, and it's still going to be much below owning. Next.
And we have nearby homes at 2 million, right? So
exactly. And it was a high growth rate in 2020 as number 8 in terms of where populations are people are moving. Very interesting. No imposed payroll tax, no state income tax. And so this has become a very attractive place for workers and for businesses to relocate. Amazon, Nissan, the state government, Dell, Oracle, Vanderbilt, and all the medical hospitals that it runs, Kroger. I mean, these are all big name places that call Nashville home. The employment growth was 2%, outpacing the national average of 1.4. This is interesting because when Nashville is adding so many hotel rooms, what that tells you is there's more business travel, there's more tourism, and there's more eyeballs and people getting on airplanes to go see Nashville. So it's all about the economic engine that it provides. Dolly Parton has been, integral to some of the economy. We have the Dollywood, and then she's building new hotels. Next, her theme park, 1.8 billion. We got the airport, 2.1 billion expansion. Nashville Yards is a development project, $2 billion annual economic impact, anchored by places such as Amazon, PwC. The corporate relocations due to the tax and then the workforce and the corporate friendly tax environment, it's unmatched, right? $36 billion of economic impact from all the relocations. Amazon itself has a huge couple of towers, 3 million square foot facility, 5,000 jobs, $4 billion of impact. Oracle, same thing. In terms of it being an educational center, they call Nashville the Athens of the South. It's due to all the universities that are available. Belmont, Tennessee State, obviously Vanderbilt, ranked number 14 in the country, Lipscomb. And between the university and the medical center, there's about $22 billion of economic impact. In and surrounding our property, there are 500 healthcare companies and probably 100 hospital systems. So it's quite healthcare capital as well. And probably on our property, as we're finishing up our due diligence, we'll probably find ed and med, if you call it. So there's a lot of educational type of jobs on the property, and probably a lot of nurses and medical folks that are actual tenants. Tons of tourism. $20 million a day. Luxury shopping is available. There was a huge $300,000 redevelopment site. Nashville is considered the music capital of the world, or music capital of the US. $5.5 million of impact. It's also the home to the Country Music Awards as well. Next. Meta, also Facebook, also known as Facebook, $1.5 million data center, which is in Gallatin, which is slightly north of Hendersonville. So that you can see how we're really sandwiched in this path of progress. This new Nissan Stadium, this is where the Tennessee Titans will play. I think it just got built, or it's coming online shortly.
Under construction. I took a jog around it during DD. It looks like it's gonna be phenomenal.
Okay. University of Tennessee and Virginia, for example, that one game had $20 million of impact that was played at that stadium. So it's pretty crazy. There's professional soccer, MLS soccer, Nashville SC, $77 million of impact. This is their minor league baseball team. And the Predators are their NHL team that's in the Bridgestone Arena, $410 million of impact. So you can see here, tons of sports teams, tons of things to do. Number one place in terms of markets to watch. So it really is a robust place to live, work, play. And that's why we think this is really an outstanding project. We're not looking for people to just say, hey, this is a deal I want to invest in. We're looking for people who want to have sort of a long-term relationship with Viking Capital and make sure that they have a proven team that can sort of have their back, have their due diligence done, and really feel comfortable with investor education as they start diversifying their portfolio. So I'm excited to present this project to you all. We're going to go through Q&A right now because I know there's a lot of good questions. And before we do that, there's just, for those people who are looking for bonus depreciation, we still are able to offer it 40% this year in 2025. There's multiple ways to invest in this project, self-directed IRAs. If you invest in a certain dollar amount or more and you bring in a network of people, you can launch a fund. You can invest with cash, self-directed 401ks, trusts, and 1031 exchanges. The hold period will be 4 years with the option to potentially refinance and hold longer if needed. But right now, the plan is to exit in 4. And so for those of you guys who are interested, there's a link in the chat box. So the team, can you put the link in the chat box for them to book a call? You can scan the QR code. You can text Hamilton to that number below. And the email we have is invest@vikingcapllc.com. Historically, deals like this, because not that many people are doing deals in the country right now, these things do fill up probably in 30, 45 days. This will be probably a full commitment for most investors. So we'd urge you guys to come, ask your questions, make sure you feel comfortable. And if this meets your investment thesis and investment criteria, we'd love for you to join us in the Viking family. And with that, Chris, I think we should start some questions. So Judah, Chris, let's have some of the first questions. I think the Q&A has them. Let me get them
We're
pulled
going
up
to
here.
moderate the questions, and Jude and I can take turns answering them.
Absolutely. All right. So where are you typically getting your capital to fund projects?
Right. So our investor base
Yeah.
is pretty broad. We have individual LPs, high net worth folks. We also have several family offices. We have, bigger institutional partners that we sometimes partner with. It's really the whole gamut.
Okay, great. People are really asking you more about the loan terms, Judah. Can you just tell them about the loan term, the assumable loan, and then, if in 4 years, if and the environment's not right, what are our options as the sponsors?
Sure. So the seller has already taken out a senior loan and a supplemental loan, both from Freddie Mac. These are Freddie Mac loans, a 30-year amortization schedule, blended at a 4.89% interest rate. Again, already fixed, already in place. We're past IO here, which means the loan is amortizing, which is nice because when we make our debt service, we're not just paying debt service, we're actually paying down the mortgage on a monthly basis as well. Which lends to the next question you asked, Vic. In 4 years from now, it'll be beneficial to have a lower loan balance because we have two options. If the property's cash flowing nicely, we can continue to cash flow it and put a new loan in place. If it's a advantageous market to sell, we can sell the property in 4 years. So having optionality is always a good thing. So it's great to have a fixed rate loan now to avoid the market volatility that's still present, while having optionality in a few years from now as to whether or not to sell when the loan matures in 4 years, or whether to keep the property for another year, 2 or 3 or 4 years. Just having all that optionality in place. I think ideally, let's sell it in 4 years. We will have completed our business plan, but having that optionality is always an extra layer of protection.
So an investor was asking, why is the current owner selling?
Great question. The seller here is closing out one of their funds. So their fund has reached maturity. Once the fund reaches maturity, they have to return capital. The only way to return capital is by selling the properties. They bought this in 2018 or 2019, I believe. So they've reached their 6 or 7 year maximum period of their investment, and they're selling. They had a little bit of wiggle room on timing, which again, they went to market with this back in the summer, ended up not selling due to the other buyer not being able to perform. They had some time to figure it out, reached out to us because they very much started feeling the pressure to sell the property. So that's why they're selling, fund maturity.
Someone was asking, hey, why are rents so low? And isn't one bedrooms less desirable?
No, one bedrooms are desirable, which is being shown by the 97, 98% occupancy on site. It really depends, who you are as a renter. The market itself has a nice balance of 1s, 2s, and even 3 bedrooms. Another question that was asked here was, what's the size of these units? And is that why there's delta in pricing? Yes, we are, I said, the affordable option. We're also one of the smaller options. A lot of tenants would rather spend a little bit less money, even if it means having a little bit of a smaller apartment, especially if they're a single young professional or maybe a retiree. So kind of answer all those questions into one. The market has proven a very strong demand for 1 bedrooms and 2 bedroom apartments, which is why this thing has stayed occupied, despite the seller having continuously raised rents, despite the seller having kind of started adding washer dryers and charging for them as well. The business plan has already been proven in place. We get to kind of carry it to fruition.
Yeah. And then why are rents so low, Judah?
Yeah, rents are low here relative to some of the newer properties that were built, right? There were a couple of new properties that were built and delivered as we showed on the slide. Those were fully leased up because there's such a strong demand here. But relative to those newer properties or 3, 4 bedroom apartments, we are 1 bedroom, so we will have lower rents. And it's 85 built. So while the property is in great shape and does have granite, does have stainless steel appliances, in comparison to some of the brand new product charging much higher rents, we are charging appropriate for where we should be. It just keeps the property very competitive and very occupied.
Chris, this is for you. What are some of the risks you see with this property and investment?
Yeah, I think that, we really like to isolate the risk. So one of the risks that you tend to see in 1980s built properties is usually part of the plan is to do a huge value add component. And we're fortunate with this property, and the value add component's been done. So the idea that we have to spend a lot of money, increase rents, that's kind of been taken off. The big risk here, I think that I would kind of point to and say this is what you should still think of after everything we've done to mitigate is where cap rates are going to go. I think most folks, you look at where we're buying this property north of a six cap, it's definitely a great deal from a cap rate perspective. The question is, in the next 4 years, are cap rates going to compress or are they going to expand? If you believe that interest rates and lack of um, new supply coming online in this area is causing cap rates to expand, the logical thought would be that you'd see some cap rate compression over the next 2 or 3 years. And that's why I was for going against what I typically like, which is putting like a 10-year loan on this to get more flexibility. So two risks that I'd identify is one, will there be enough cap rate compression over the next 4 years to sell this property and get the value that we want to get out of it? That's one thing every investor should ask themselves. The second one is, do you believe that transaction volume and the lack of supply is going to continue? I think with lack of supply, you have to look at you can't build 1980s properties. So even if over the next couple years, developers see the opportunity in this area and they say, we want to build in this area because there's undersupply, they have to build top of the market. We had that slide that showed what that would cost and where rents would have to be to justify building with construction costs today. So that's why I think Judah pointed out really, correctly that the property, it's hard to replace this value and have a 1980s property that you can rent at these prices. You just can't recreate that by building more.
And what is the timeline for this deal, Chris?
Yeah, so typically, and this was no different, we hope to close the property within 60 to 75 days of launch, which is right now. I think what we've engineered into the agreement with this deal is up to 90 days with a 30-day extension, but the goal would be to close in the next 60 days. And I think we have the traction to do so.
And so people are asking, Chris, if we can share like our underwriting or our pro forma and how we got to these calculations. Is there a way for them to learn more about that?
Yeah, absolutely. So my team and I have developed a deal room. We're going to be sending out follow-up emails after this webinar with the replay of this. I usually will do a performer review video. Any of you guys that have, been with us for the last few deals have seen these, where I usually will walk through the model line by line with a few investors and ask them if I can share that. So that will go out to you to where if you don't have an hour and a half to sit down with me and go through it yourself, there'll be a recording that you can watch and we'll go and point out, and that's where I really can point out any risks that I really identify or soft spots in the deal. I definitely implore everyone to watch that video. And then, of course, we would share the model. We would share any information that you're looking for. We're very transparent about the way we underwrote the deal and how we came to these conclusions. Just reach out to us and you'll get what you're looking for.
And then, Judah, who's going to be managing this asset? And
Yeah.
how does Viking's role? And then if we have a property management company on board, how does that work?
Absolutely. So we will be working with Pegasus Residential to man as a third-party manager on site. They will be the ones, kind of their staff in the leasing office, their maintenance staff on site. However, Viking very much will be the asset manager, meaning we will be overseeing them. Edmund Archick, our director of asset management, he's already been on site with me, toured the property, walked the units. He will be on weekly calls with the whole team, making sure leasing traffic is what it should be, making sure that the construction management and renovation projects are progressing accordingly, and making sure that all the tenants are being taken care of and that we continue to have a positive reputation. So we very much manage the project along with Pegasus Residential, who will be the on-site team.
There's a question for Chris. Can people invest using different investment vehicles? Like, is there a 1031 option? Is there an IRA? Things like that.
We're definitely set up to take self-directed IRAs. On this particular deal, it isn't set up to take 1031s, but we do have other investment opportunities that are open that do take 1031s. So if you need to quickly identify or you have 1031 money that you're looking to place, do reach out to our team. We have options available. It's just not this property.
And people are wondering, despite whatever class they end up investing in, do they get a K1 at the end of the year?
Yes, so anyone that invests in this deal through any investment vehicle will receive a K1, and that's going to detail what you invested. It's going to show the depreciation, your share of the depreciation that can be used to offset any passive income you might have. And it's also going to detail the passive income that you've received from this investment on an annual basis until we sell.
So people who invest, Chris, if they're interested in the bonus depreciation, how does that work and how will they see that reflected?
Yeah, so I can explain it in more detail. If you really want to dive in, please call my team and myself. But generally, every property will have a cost segregation study done. And the way that cost segregation study works is they go to the property and they itemize parts of the property into 5, 10, 15, and 20-year buckets of how long it takes, different parts, the roofs, the washing machines, the concrete, the pool, what depreciates at what time. And they will accelerate that depreciation as much as they can based off of each item and what bucket it falls in. What you're left with is economic report from the cost seg economist that says in year one, you can depreciate this much value. So say it's $10 million. In this year, with the step down that's been happening in the step down of the depreciation program that's allowed, you're able to take 40% of that and actually utilize it in year one. So if there's $10 million from the cost seg study, you can take $4 million, and that $4 million will be spread equally amongst all of the investment amounts of money that gets invested into the deal. Viking, as the sponsor, takes none of the depreciation. It gets spread equally throughout all of the LPs. And then once you have that depreciation in your K1, if you have any other passive income, so think not your W-2 income, think if you own a rental property that you're renting out and you're getting income, that's passive. If you, any of the income that you get from this investment, passive. Other investments like this, passive. You'll be able to use these losses to offset those gains and not pay taxes until you recapture when we sell the property. Like I said, it's pretty complicated, but one-on-one calls would probably be best to really dive into the minute details.
Absolutely. Great work, Chris. People wondering, hey, when's the first distribution after closing?
Yeah, usually the way that we set that up is 45 days to 60 days after close, we start paying distributions, and they come monthly.
So the question that we're having a couple of them is, there's actually a funny one. It was like, can we use the property on the weekends if they were flying in? Hey, maybe we should make an investor suite just for the investors. Why not? But in seriousness, some of the questions were, hey, how do you feel you're going to be well capitalized and underwritten, despite the good rates based on, market volatility?
Yeah, so one thing that we do when we underwrite is our goal is to fully capitalize up front. That means for all of our capital projects, construction projects, repurposing of tennis courts, amenities, landscaping, anything that's capital below the line, we raise money day one to be able to fund throughout our investment period. So we don't hope that cash flow will sustain a capital project. Cash flow is that what our investors earn and what we pay out to them by distributions. So we make sure that everything is budgeted. We already had contractors come out to the site. We've already been building up our budget. So we'll know every dollar that we plan to spend before we close to make sure it's all accounted for.
Chris, can you go through the minimums again?
Yeah, the minimum investment is 50,000, and the minimum for reserve class, which has the stronger economics as a reward for a higher investment amount, is 500,000.
Great. All right. I think those were the biggest ones. I know there's a ton more, but I try to at least go through all the different ones to see people got a flavor of the different kind of questions people are asking. I think the rest of it can be answered with the one-on-one calls. And then investment team, please see if you can capture some of this Q&A so we can address it as well. Guys, I would really encourage you guys to book a call with the team and just expand your education on real estate, number one, and two, on this particular project. Our team is an open book. We pride ourselves in our transparency and we advocate for our investors, right? If based on your particular situation, this is a great deal, we'll tell you. If not, we'll say, hey, maybe this is not the right project, and we'll maybe guide you to something else. But bottom line is we're an investor-centric company. We really care about what makes sense for our investors. I really believe that you guys are coming in with us and Viking in after the Great Reset. I really think that 2024 was the bottom of the market. And I think the next 3 to 5 years is a nice upcycle. And I think interest rates are going to eventually reflect that. And, this is what wealth building is about. This is about compounding results, compounding success, and really taking advantage of this next trajectory of where real estate's going. So thank you again, guys, for your time. I really appreciate it. Thank you, Judah. Thank you, Chris. And thank you, team. If you guys need anything, just please hit us up. Here's the contact information. You can scan the QR code. You can text Hamilton. There's a link in the chat box right now as well. I encourage you guys to go ahead and book calls. We have already a significant amount of interest on this deal. We think it will close pretty quickly because we haven't had a traditional value add deal in a while. And so people have been asking for one of these. So these tend to fill up in about 40 to about 55 days. So, all right. Thank you so much, guys, and have a good evening. We'll talk soon.